Hey, what's up, guys and gals? That's right. The stimulus extension passed. You might or you might not get a $600 stimulus check. You might get extended unemployment. But beyond all of that, I bet that there is one portion of the CARES Act extension, this new stimulus bill, that you've never heard of. And yet it will impact your life and it has implications for our economy over and above, way more important than anything else. Stay tuned and I'm going to tell you about it.
Fairy dust.
Now, do you remember Enron, the Enron scandal of the late 90s? Maybe you do, maybe you're too young to know or to remember, but maybe you read about it in school. Either way, what I'm about to go over with you has some parallels with the Enron scandal of the late 1990s, early 2000s. Enron was not a typical utility company. And I know this whole title is about stimulus and how it affects you, and we're going to get to it, I promise. Please stay with me. In the meantime, please click like and subscribe. Really will help me out. Now, let's go ahead and get into Enron. Then we're going to get into how I compare Enron to the stimulus bill. Okay, so quick summary of Enron. Enron was a utility company back in the late 90s that ended up going bankrupt in 2001 when it was uncovered that the company all the way up to its top executives had committed a massive accounting fraud. Their public auditor, Arthur Andersen, ended up going bankrupt shortly after in 2002, and there's a lot of speculation about it being a cover-up and an inside job. In a nutshell, Enron was lying on its financial statements, specifically around a concept called mark-to-market accounting. If you want a good film to watch on mark-to-market accounting, I suggest that you go look up a documentary called Enron, the Smartest Guys in the Room. Okay, so before we go any further, we have to do a quick summary of what mark-to-market accounting is. Under generally accepted accounting principles, or GAAP, companies are required to mark the value of their assets and the value of their cash flows at the end of every quarter before releasing their financial statements. Now, if you're a utility company, normally, or if you're a manufacturer of tires, let's use tires as an example, the value of your assets doesn't change that much, right? You have rubber, you have a plant, you have machinery, those things depreciate over time, but the value doesn't fluctuate that much. Financial institutions, on the other hand, generally have big mark-to-market swings as the financial markets change, as interest rates go up or down, and the for transparency purposes, GAAP accounting mark-to-market requirements say that an institution is supposed to revalue and remark its assets to the market price, if you will, at the end of every quarter for the purposes of being transparent to its investors. So in Enron's case, most utility companies are very boring, right? They own electrical grids, they own pipelines, and they own other infrastructure. Enron had all of these things, but it had a very robust and seemingly profitable trading business. And the reason why utility companies might have a trading business is because they look forward into the future and buy futures contracts on things that they need in order to hedge their risk of prices going up. So in the case of an energy company, they would buy oil and gas futures, they would buy electrical grid futures back in the 90s before it was all governmentalized. And Enron was booking huge profits from its trading activities. However, when it would take a big loss, Enron would simply put the loss on a off-balance sheet subsidiary and fail to mark-to-market the value of those losses. And in turn, by not factoring in the value of the losses, they were greatly overstating their profitability.
I wanted to discuss your marks, make sure they're fair.
Yeah, I think you mean that you've secured a net short position yourself, so you're free to mark my swaps accurately for once, because it's now in your interest to do so.
Okay, so I know that's a lot, but now we're going to get into that mark-to-market scenario, how it impacts the CARES Act, and how it's going to impact the real estate market in 2021, specifically the commercial real estate market, but really the broader economy as a whole. Okay, so I know back in March, everybody remembers the sky was literally falling, right? Individuals, households, students, businesses, everybody stopped paying their bills. The treasury market was in free fall. Things were really bad really quick. So in order to try and stem the bleeding and in order to try and hit pause, the government came out with all of these programs, right? They paused student loan payments, paused household payments, mortgage payments, paused rent payments. You didn't have to pay your utility bills, in addition to giving stimulus and everything else. The idea here was to hit pause, wait till everybody gets better and gets back to work, and then hit play again, as if the global economy is a freaking Xbox game or something. The problem when you do this is that when you hit pause, you got to remember that we have a debt-based monetary system, and a loan, a debt, is simultaneously an asset and a liability. On the one hand, it's a liability of the borrower, right? We all know that debt is a liability for us, right? We go buy a car, we have a car loan, that's a liability, we got to pay it off. You buy a home, you got a home loan, that's a liability, you got to pay it off. What most people don't realize is that that loan is actually an asset of the lender, because that loan represents a predictable stream of cash flow over time of principal and interest and, going to the lender. And the lender is supposed to book that principal, those payments as cash flow, or book the lack of payments as a subtraction to cash flow, and also value the loan as a whole. Loans are valued based on a net present value type of approach, where you take the stream of the cash flows, you discount it back to present value, and here's what the value of the loan is. And as I'm sure you guys know from movies like The Big Short, or any quick Google search, there's a huge market for buying and selling loans. Financial institutions, pension funds, sovereign wealth funds, big institutional money goes into buying loans for the purposes of having that asset and relying on that predictable income stream over time. But what the general public doesn't realize is that there's this trickle up effect. If I stop paying my home loan, that means that the mortgage servicer that collects my payments isn't getting their strip of the payment. That means that Fannie Mae, who owns my loan, is not getting its cash flow. And that means that the California State Teachers Pension Fund, who ultimately owns my home loan, isn't getting its share of my payment. So there's this trickle up effect. And to be clear, forbearance is a great thing. If you've lost your job and you can't make your payments, by all means, take forbearance, be smart about it. We're living in crazy times. But there's a difference between forbearance and the accounting mechanism and the way that lenders and financial institutions are supposed to account for non-performing loans. And that's where the Enron style accounting gray area comes into play. So to be clear, I'm not when I talk about mark-to-market accounting and how this is going to impact the real estate market going forward, I'm not talking about the borrower receiving forbearance. I'm talking about, because of the borrower receiving forbearance, that has a trickle-up effect in the way that banks and lenders should be doing their accounting versus what's being allowed for their accounting practices under the CARES Act and under this new stimulus extension bill. Okay, so here I wanted to show you guys two sources where I got the information on the CARES Act and specifically the accounting exemptions in the CARES Act. Because frankly, you, as I've been blabbering on about, you won't hear about it in any of the news media. It's not sexy enough to talk about. It would bore everybody to death. But again, this really can impact the markets. The first is this is the Journal of Financial Accountancy, and this is from April. This is an analysis of the original CARES Act. And quite simply, financial institutions using CARES Act deferrals won't violate GAAP, the SEC says. Eligible financial institutions, which is basically any lender, credit union, bank, Fannie Mae, Freddie Mac, etc., will not violate GAAP if they take advantage of deferrals and suspension under the permitted new federal coronavirus relief law. If you scroll down here, it gives you the specific sections, and it talks about, doing debt restructurings as a hope, and wanting to suspend mark to market and suspend GAAP accounting treatment in order to on COVID assets, in order to try to facilitate loan workouts and facilitate modifications. So that's in March. So that was in the original COVID bill in March, the original CARES Act. Now this is from a law firm who's just examined the new, stimulus number 2, the $900 billion, and in Title V of that, under the banking section, in miscellaneous, it clearly extends through January 2021 the for banks, insured banks, credit unions, and affiliates from the CECL, which is the non-performing loan standards that they're supposed to be complying with. Again, it says that through January 2022, they're exempt from having to do this, and the hope is that this gives lenders additional flexibility in order to help facilitate loan mods and et cetera. Okay, so let's say I'm an apartment owner. I own a 100-unit apartment in downtown Los Angeles. 20% of my tenants currently are not paying rent because they've lost their jobs, because the government has put in an eviction moratorium, pretty much no questions asked. If you can't pay your rent, you don't have to. You can't be evicted. I have a mortgage on that apartment building, and because of this 20% loss in income, I'm not able to pay the mortgage, so I take forbearance. On my financial statements, if I'm a cash accounting basis, I'm actually booking the fact that I'm not taking the 20% income in. If it's accrual basis, I might be holding that 20% income in a receivable account. Since I can't evict tenants, I don't charge it off yet. Because what if the tenants pay, or what if the government comes in with a city program and makes me whole? So that money is sort of in purgatory. Now trickling up to the lender is not getting paid his portion, his mortgage from my loan. I'm not paying my loan, and so typically the lender would have to book that as lost revenue, and typically the lender would have to show the present value of my loan going down under mark-to-market accounting because my payments are not coming in. But the lender is able to hold my mortgage payments in a receivable account, just like I'm able to hold my tenants' rent payments in a receivable account. And as a result, that receivable account is being added to revenue, and they're not making those adjustments. So come time to issue quarterly financial statements, my lender, let's call it, Blackstone Mortgage REIT, my lender is reporting, inflated income, to put it nicely, and an inflated net asset value on its balance sheet. And as a result, since the banks do not have to report the losses as they would normally have to, and since they don't have to put a capital cushion behind non-performing loans, there really is no incentive for a bank to foreclose. Now, the government gave them this exemption because they're hoping that they do loan mods and do workouts and try to get people, back into a performing status. But really, the end result is purgatory. There's no incentive for a lender to foreclose or mark down or write off a bad loan because it's not hitting their financials and therefore not affecting their stock prices like it would be in, call it, 2009. And so because there's no incentive to foreclose and no incentive to sort of clean up the books, I don't see a real estate crash in 2021. Now, if banks, at the end of 2021, if it doesn't get extended again and again and again, then you generally have an environment where banks would be incentivized to get rid of bad assets as quickly as possible in order to obtain a higher market price for those assets. Supply and demand kicks in, and that's when you have a major financial problem like we saw in 2008 when everybody was trying to unwind and get rid of subprime mortgage-backed securities overnight. But let's say that the gap suspension and the non-performing loan exemptions expired and lenders had to go back to the normal transparent rules. Well, then there'd be a rush to the exits.
Hallway. One at a time.
Lenders would try to write down and sell non-performing loans as quickly as possible in order to get a higher market price. And that's when you could have excess inventory coming online, prices falling, et cetera, et cetera. And now I know that politicians would love to extend both eviction moratoriums, forbearance programs, and obviously extend how lenders account for these indefinitely, right? They love to kick the can down the road infinitely in order to make everything look rosy and in order to get reelected. The problem is I don't know how long the government can actually suspend economic gravity.
Fairy dust.
Okay, that's it for this video, guys. Let me know what you think in the comments below. Am I crazy? I'll also include the links to the articles that I mentioned below and the citations so that you can see and read exactly about the accounting exemptions that I'm talking about that were baked into the CARES Act, now extended through 2021, yet not reported on at all by any news media outlet. If you do me a favor, if you do like this video, please click the thumbs up button for the YouTube voodoo, help get this video to more people, and also please consider subscribing. It'll really help out the channel. Thanks everyone, and I'll see you in the next one.